Hi, everyone. My name is Manju Puri. I'm the JB Fuqua professor at the Fuqua School of Business. And today I'm going to be talking to you about digital footprints and their implications for credit scoring. So this is based on a recent paper that I published in the Review of Financial Studies. So the way we'll structure this is I'll first go through the paper with some slides, and that'll be for 15 to 20 minutes. And after that, I'll be taking questions. So as I'm presenting, if you have questions, feel free to go ahead and put it in the chat. And so, don't wait till the end. You can keep putting in the questions. And so then when we get to the questions, I'll be able to address them. Okay, so let's start the presentation. So let me switch at this point to the slides. And so this is on the rise of FinTechs, credit scoring using digital footprints. And this is joint work with Tobias Burke, Valentin Burke, and Anna Gombovich. And as I mentioned, we published a paper in the Review of Financial Studies using this paper. So let me start with the motivation. So the motivation is pretty straightforward. And that is, these days, we're all fairly aware that whenever we go online, we're leaving some information behind. So we've become pretty careful about what we do on Facebook or Twitter. But nonetheless, almost all of us, without exception, regularly access the internet, regularly, go to websites to shop or read articles, access it and register. And so the question is, simply by accessing and registering on a website, how much information do you leave behind, right? And I'm just talking of a shallow, bare bones digital footprint. Simply by the act of surfing, how much information do you leave behind? And I think the answer is going to surprise you. The answer, in short, is going to be a lot. And I'm going to quantify just how much is a lot. And this has a lot of implications. It has implications for banks and their business models and how they do credit scoring. It has implications for access of credit to the unbanked, and it has implications for all of us as consumers, for firms, and for regulators in the digital sphere. So let me start as motivation with this picture. So this is a picture of New York City. Now, it's a very strange looking picture, but so let me explain what it is. So the way this picture is constructed, the red dots are people using iOS systems. So if you're using an iPhone, you're going to show up in red. The green dots are people using Android, and the purple dots are people using BlackBerry. And so if I was a woman from Mars, right, I know nothing about the US, let alone New York City, how much information would I collect just by knowing this, right? And this is simply one data point, right? And that is, what is the operating system? Am I using iOS or Android? And it's publicly available. And so what we can say is, here in the island of Manhattan, there's a mass of red points, right? Lots and lots of people here are using iPhones. Now, as you go out to New Jersey and Brooklyn, you see a lot more greens. And in the heart of Manhattan, you see a few purple dots or blackberries. So what does this mean? So there's been some interesting research recently that has looked at what are the differences between the rich and the poor through the ages. So once upon a time, it used to be, do I have cable TV? Do I have a BMW? In today's world, it's, do I have an iPhone or not? And so iPhone tends to correlate with income levels. And so you can see in this that all these red dots, they're sort of concentrated in Manhattan. This is where all the wealth is. And as you start moving out, to New Jersey, Brooklyn, you see more of green dots. And what are the purple dots or the blackberries? Well, like the Obamas of the world who refuse to give up their blackberries, that's what they are here. Or it might well be bank-issued blackberries. Now, this is a single data point, single publicly available data point. And yet, simply by knowing that and knowing nothing else about New York and Manhattan, we can actually figure out quite a lot. And so this is a motivation to look at, there's a lot more data points that we leave behind on the system when we access a website. What is that going to look like? And so the way we conduct this research is we get data from an e-commerce company in Germany. This is very similar to Wayfair. So you shop, you see a coffee table or a sofa, you buy it, and then you bill for it, and then you pay for it. So it's like a short-term consumer loan. The default rate is 0.9%, but remember this is short-term, so annualized it's about 3%. And that's roughly very similar to, in general, the default rate for consumer loans in Germany as well as in the US. Okay, so what do I mean by digital footprint? And so I'm going to define a bare bones, shallow digital footprint. And this is like the minimal information that you leave behind when you access and register on a website. And I've put 10 variables and I've divided them in 3 buckets. So let's go through them. So the first is device type. Do I access through a desktop, a tablet, or a mobile? The second is the operating system. Is it iOS or Android? And as I had motivated it, right, iOS or iPhone is correlated with wealth. And so research has shown that having an iPhone sort of is a good predictor for you being in the top quartile by income. Then what is your email provider? Are you using a free email service like Gmail or an old free email service, let's say Yahoo or Hotmail? Or are you using a paid email service? So it turns out in Germany, a paid email service is T-Online. So it's a little like AOL. So you buy, cable TV and other things, and you also get an email address. And so clearly, in order to have a paid email address, you have to have some money. And so this is likely correlated with income. The next 4 variables, right, are related to things you might have heard in marketing. So the channel, how do you get to that web page? Do you click on links? Do you actually type in the website that you want to go to? And so there's research that suggests in marketing that, impulse shopping and personality traits can matter. And so one of the questions we ask is, who is more likely to default, the person who clicks on those paid links or the person who actually enters the name of the website they want to go to? And as you might guess, people who click on paid links, they are more likely to default. We then look at the checkout time, and that is, what time of the day do you do the purchase? Is it morning, noon, or night? And so when do you think people are going to default the most? So it turns out people who shop between midnight and 6 a.m. are the most likely to default. Then we have a do not track setting, and we have email error, right? And that is, you put in the email address and it bounces. And so if you either stole that email or you're so drunk you can't type straight, that email bounces, it's not a good sign. And that's what we find, that if the email address, if it bounces in the first attempt, default rate is actually higher. The next 3 variables are about the email address itself, right? And so there's a growing research in entrepreneurship that suggests that if you put your name on something, it actually matters. So similarly, does your email address contain either your first or your last name, right? Or is it something like Sunflower 001? And so who do you think defaults more? Someone who puts their name in their email? So my email is mpuri or Sunflower 001. And it turns out it's Sunflower 001. And similarly, if your email address contains a number, the default rate is higher. And then we look at how you type it in, right? Do you type everything in lowercase, or like civilized people, do you actually capitalize the first name, the last name, and the street and city? And people who type all in lowercase, they actually default more. Now here's a picture, right? And in this picture, we have, on the x-axis, the default rates, and on the y-axis, the variables. So let's start with the credit bureau score, right? And so a credit bureau score, it's collated over a long period of time. It tracks all your loans, with your payments are made on time, et cetera, et cetera. And so there's a lot of time and effort put into the credit bureau score. And so what we see is, if we look at the difference between the highest decile of the credit bureau score and the lowest decile, there is a big difference in default rates. And this is as it should be. And so if you're working for a credit bureau, you would be happy with this result. Now let's look at the digital footprint. Let me look at just two variables of the digital footprint. And that is, if you use a Mac and a paid email, this is Mac and T online, versus if you use Android and a free old email, Hotmail or Yahoo, you can see the difference in default rates between these two is higher than the difference between the top and the lowest decile of the credit bureau scores. And so far, we're using only two variables, right? So this is already telling you, there's a lot of very powerful information in the digital footprint, or the information that you leave behind. So how do we measure, how powerful the digital footprint is? And so we're going to look at area under the curve. We didn't invent this methodology. It's well honed methodology used in economics. Basically, you're running a logit where the left-hand side is a dummy variable, which is 1 if you default, 0 otherwise. And the idea here is, if I flip a coin and then it's 50%, right? It's random which way the coin is going to lie. That's going to be the equivalent of this 45-degree line, right? It's not informative. It's a random prediction of default. On the other hand, if I have some methodology, let's say the credit bureau score or other information, and here I have, if I look here, what do I have? I have the lowest 25% of score is giving me 65% of the default. Okay, and so is 65% a good sort of area under the curve or not? And so research suggests that any number between 60 to 70% is actually a pretty decent number in terms of predictive power of default. And so now let's measure the credit bureau score, area under the curve versus digital footprint. And so when I look at the credit bureau score, the area under the curve is 68.3%. Now, this is good news for the credit bureaus, right? Because, as I said, anything up between 60 to 70% is good. And so the credit bureau score is doing its job. But now if I take my simple bare bones digital footprint, just these 10 variables that you leave behind when you access and register on a website, we're actually getting an area under the curve of 69.6%. So we're doing, as well as the credit bureau score. And when you put the two together, you actually do even better. You add another 5.3%, in terms of area under the curve. And so it actually just using both is a good idea. But if you think of a credit bureau score, think of the manpower involved, the people, the history that they're tracking, all your credit cards, the loan repayment. It's enormous amounts of information, which is very labor intensive. And think, how long does it take to get the digital footprint? It's almost instantaneously, and yet it seems to be equally powerful. And when we compare this to other studies, we find, the numbers do well. The numbers that I do want to compare it to are banks' internal ratings. Now, banks, as we know, they produce a lot of information. They screen your credit, they monitor you. And so how much more do they add to the credit bureau score? And so in research that we've done using 300, the universe of savings banks in Germany, we find it's somewhere between 9 to 12%, right, over the credit bureau score. So this is good news, because banks are putting in a lot of effort, and it's telling you there is value add from all that effort. But my digital footprint is already doing half as well. And this is just a bare bones digital footprint. It's already, covering another 5.3% over the credit bureau score when I add it to that. And so this is telling you the information advantage of banks is getting threatened by digital footprints. Now, does the digital footprint predict future credit bureau scores, right? And so what we have so far is for consumers, short-term consumer loans. Now, it would be great to look at other credit products and mortgages. We don't have the data. But what we can do is look at, does the digital footprint predict your future credit bureau scores? And the answer is it does. Right? And so if you think about it, the credit bureau score, it's accumulation of your historical record. The digital footprint is capturing you as you are today. And so maybe you had a stellar career, great job, great credit. And now what's happened? Hey, you lost your job, you got depressed, started drinking at night, at 2 a.m., would fish out the mobile, start clicking on links and shopping and purchasing stuff. Now that is going to show up in the digital footprint. It will take time to show up in the credit bureau score. And so that's what we find. The digital footprint actually predicts your future credit bureau scores. And we find the company that once it introduced the digital footprint, you can see default rates went down dramatically. So what are some of the implications of this? So I'm going to discuss very briefly 3 implications. One that I've touched upon is the implications for other intermediaries like banks, right, which have a record and a history of producing information. And the digital footprint is now going to threaten sort of traditional ways of information gathering, right? And so some important questions are, should banks use such information? Would regulators allow it? Is this information durable? How well would these alternate credit scoring or social credit scoring mechanisms do through the cycle in both up times as well as down times? A second question is the implication for credit for the unbanked. And, there are more than 2 billion working age adults in the world that don't have access to financial services. And so there's high expectation for digital footprints. Can this give access to credit? And so we can actually test for that because 6% of our data, they actually do not have credit bureau scores. And here, when we do our estimation, what we find is that the digital footprint actually works even better for these unscorable customers, right? The area under the curve is more than 72%, right? Which is actually higher than for the scorable customers. And so this gives us hope that maybe we can, give access to credit to the unbanked using digital footprints, because the unbanked don't have the traditional credit scores and all the other metrics that we use to give credit. And then the third implication is, what about behavior of, what does it mean for us as consumers? How should we behave? What does it mean for firms and for regulators? And if everyone knows about this, wouldn't we change our behavior? So in economics, we call that the Lucas critique. And if we change our behavior, we change our behavior, right? And so it's like in the old days, if you wanted credit and you'd go to a bank, you'd put on a suit, you try to look good so that the loan officer would think well of you. Now, every time we go online, do we put on a digital suit to protect ourselves from all of these eyes? And beyond consumer behavior, what about firms? How do they respond? What about regulators? What about potential discrimination that might happen? In the US, we have the Fair Lending Act that doesn't allow things like race and gender to be used. But, could alternate credit sources or social credit scoring actually start using some of these? And so to conclude, right, so we look at the digital footprint and ask, is it useful for predicting payment behavior? And the answer is yes, even a shallow digital footprint, information you leave behind simply by accessing and registering on the web has similar predictive power to credit bureau scores. Our research suggests it's a complement rather than a substitute. And so if you add the two together, you actually do better. It works equally well for unscorable customers. So it gives us hope for banking the unbanked. And, it also opens a whole host of other questions, right? And it has lots and lots of implications, right? And so, what is the right model for financial intermediaries? How far should digital footprints be used? How well can it be used to give loans to those who don't have traditional credit bureau scores? And then, last but not least, does it mean that we as consumers modify our behavior? And how should regulators sort of respond? So that concludes the presentation. At this point, I'd like to turn to get questions, and we can go ahead and address any questions you have. Okay, so the first question that I have is, you've talked a lot about shallow digital footprints, but there's a lot more information available on the web, right? And so, you can go and harvest so much more. So have you looked at that, and what is your view about that? And that is a good question, right? And arguably, if you have more information, you're going to do even better in terms of predicting future default, right? And so what we have, and we almost purposely did this, was took a bare bones, a very shallow digital footprint, and show that it has enormous predictive powers. Now, there are companies out there that actually take, much more information for you. So an example is Thala, which gives credit in emerging market economies, and they actually ask for your mobile phone data. So they take that and they analyze it, and they have some really interesting results. So they find, people who have lots of social contacts in, lots of numbers in the directory, they tend to default less. People who call their mother every week, they default less. People who have the same pattern, right, weekly, they sort of go on the same routine, everything, they tend to default less. And so harvesting this deep digital footprint almost surely, right, will give you more information and not less. Okay, the next question is by Richard, who asks, how long must a user interact with the internet to build the requisite digital footprint for the accuracy of the digital footprint? And the answer is not long, right? 10 seconds. So long as you go and you register, right? We then have those 10 variables that we talked about, right? I know if you're using an iPhone, I know what time of the day you're coming, I know your email address, whether it's Gmail or Yahoo or something else. And that's it. And so not long at all. That's the beauty of this. You just go, enter the information, and that information is harvested almost instantaneously, right? Okay, then we have another question from an alum, and this is Rob Brewster, who asks, is there any evidence that credit scoring of any kind is actually better than scoring as it was before it was updated 20 or so years ago? Okay, so, so this is a nuance. I'm going to give you a nuanced answer, right? First, you have to recognize that credit bureau scores are also being updated continuously over time. And so if we look at our traditional metrics of information, whether it's a credit rating or credit bureau scores, these tend to become more informative over time. Like in research that I've done, I have looked at pre-1930s credit ratings on bonds. Right, and I looked at current day credit ratings, and the explanatory power of credit ratings pre-1930 is something like 10%, and today it would be 90%, right? And so all our public measures, they tend to become more informative over time. And what this is, and that's good news, that's as it should be. But what this is telling you is, despite that, the digital footprint is doing equally equally well. Okay, the next question is from Darlene, who says, who will organize the footprint? Are we going to see agencies harvest this information and sell it? Okay, so this touches on a number of important points. And one is the whole privacy issue. Who owns the information? Is it the consumer? Is it the firm? And this is a matter of great debate, right? And so there are rules coming up in Europe and everywhere else as to, who should own the information and give access to it. And in some economies, like in India, it is the consumer who has that information, right? And so the consumer can choose to give it. Now, having said that, so that I want to separate out the privacy issue from the owning issue, right? And so one issue is, can I sell this information to someone else, right? And so I harvest this information and I sell it, and there are going to be privacy laws about that. The second is almost every firm, and most of us, and at Fuqua, we have a website, I have a website, we all have our websites. So we can harvest the information on our own website, even if we're not selling it. And that's what the firm that the e-commerce company is doing. And that is people who are coming there and they're ordering their furniture. This is the information that they leave behind. So this is over and above the privacy issue, right? It's a separate issue. And that is, I can simply harvest the information from my own website and actually say a lot about who's coming from there. Okay, now the next question is, should we abandon traditional credit scoring methods and go for digital footprints? And here, I would say we want to be very, very cautious, right? When we think of traditional credit scoring mechanisms, they have stood the test of time. Digital footprints are relatively new. And so, yes, it's predicting default now. It's predicting default in a certain period of time when the economy is a certain way. What happens when the economy changes? What happens when consumers learn about this? Like now that you and I know about this, I certainly am much more careful when I go to the internet, right? I still leave information behind, but I'm more careful. I'm more likely to use privacy settings and other things. And so that could change behavior, which means the digital footprint that gives you a good prediction today may or may not be a good predictor of default tomorrow. And so this needs to stand the test of time. Most likely what you're going to need is a dynamic digital footprint over time, right? And these are things that we should think about, and I'd like to leave to all of you to think about, right? Because it affects all of us, right? All of us access the internet. And so just think about how much information you leave. And many of us, we're in business or we're in entrepreneurs. And so how much of this information would we like to harvest? And what would the implications be? Okay, so I think we're at the end of the allocated time. So thank you all of you for listening in to LinkedIn Live. Stay tuned for the next Fuqua LinkedIn Live, and my colleague Cam Harvey will be presenting.